Brexit, nearly a decade on, and most people think the story's done. But when it comes to UK finance, the impact is still unfolding. Not in one big headline, but in thousands of subtle changes that have reshaped how money moves in and out of this country. Today we're exploring the hidden impact of Brexit on UK finance, the parts you haven't heard an analyst on TV talk about. Paths, things like jobs, investment, capital markets, and London's role in the global financial system. So stick around, because this isn't just history, it's the future of your money. Let's start with what actually changed. Before Brexit, UK financial firms had something called passporting rights. That meant if a bank or insurer was licensed in the UK, it could operate across the entire EU without extra approvals. London was Europe's financial hub for a reason: easy access. But when the UK left the EU in 2020, those passporting rights disappeared. All of a sudden, UK firms needed separate licenses in every EU country they dealt with. That's a big deal. It didn't hit overnight, but the long game changed. This isn't opinion. Passporting privileges ended and regulatory divergence began, meaning firms now juggle multiple rulebooks. That's a lasting structural shift that affects costs, compliance, and strategic decisions. London isn't disconnected from Europe. It's just a more complex place to do business. Now let's talk investment, the real engine of economic growth. Independent research, including from Cambridge Econometrics, shows that the UK economy is now billions smaller than it would have been if Brexit hadn't happened. One study estimates UK GDP is about £140 billion lower today than in a world where Brexit didn't happen, and London alone is about £30 billion smaller. Put simply, fewer investments were made than would have happened without Brexit. That affects productivity, job creation, and even everyday incomes. The same report estimates London has around 290,000 fewer jobs than it would have had without Brexit. That's the hidden cost most people never talk about. You might have heard that Brexit caused a mass exodus of banking jobs, but the reality is more nuanced. Initial worst-case forecasts predicted as many as 75,000 financial services jobs could be lost to the EU. In reality, many estimates now suggest the number of roles that have actually relocated to EU cities is in the low thousands. For example, think tank data from New Financial and EY estimates that around 7,000 to 7,600 jobs and significant assets have moved from the UK to EU locations like Dublin, Luxembourg, and Paris. Now here's the twist. While some jobs relocated, many international banks and asset managers kept or even grew headcount in London, especially front office and global functions. That means Brexit didn't unleash a dramatic flight, but it did shift the geography of where financial activity happens. So jobs didn't magically vanish. They reshaped how firms balance their global workforces. Jobs are one thing, but what about money itself? One of the clearest shifts has been in assets. Reports estimate that hundreds of billions of pounds of banking assets have been moved or earmarked to move to the EU since Brexit, approaching figures near £900 billion. This doesn't mean London doesn't trade or still isn't active. Far from it. London's capital markets remain deep and liquid, even deeper relative to EU markets in many measures. In fact, recent analysis shows UK capital markets are almost twice as deep relative to GDP compared with EU nations. But the direction of capital flows tells a story. EU banks operating in the UK still lend into the EU, but regulatory change and the absence of passporting encourage firms to house assets in the EU for easier access. That's not collapse mob, but it is redrawing the flow lines of money. Now let's talk about investors. Data from investment research firms shows that since the Brexit vote in 2016, more than £118 billion has flowed out of UK-focused equity funds, and net outflows have continued recently. That doesn't mean UK stocks are worthless, quite the opposite. The FTSE 100 has hit new highs in recent years, but investors often prefer global or EU-friendly portfolios. That's partly due to fiscal and regulatory uncertainty post-Brexit. Fund outflows limit available capital for businesses to borrow or expand, which can have knock-on effects on growth, hiring, and productivity. Money moves where confidence and access travel best. So why has Brexit shaped financial services this way? It all comes down to one idea: regulatory and market friction. Passporting was removed when the UK left the EU, and although equivalence mechanisms exist, neither side guaranteed fully symmetrical access. That means UK firms face higher compliance costs, duplicate legal structures, and more administrative hurdles to serve EU clients. Banks have responded by building subsidiaries within the EU, hiring local staff, and in some cases reducing certain types of business in the UK simply because serving EU clients from London is harder. It's not about technology or demand, it's about rules and access. Here's the key point. Brexit hasn't destroyed London's financial stature, but it has reshaped it. London is still one of the deepest capital markets in the world. It remains a global hub for foreign exchange, derivatives, and international investment. Despite disrupted EU access, the UK has attracted significant foreign direct investment in financial services, often more than any single EU market in recent years. That's partly due to non-EU ties, such as US and Asian capital flows, and the UK's English-language legal framework, integrated clearing infrastructure, and large institutional investor base. London's advantage is now global rather than purely European, and that's an important distinction. It's still a powerhouse, just with a different set of trading partners and relationships. Let's zoom out. Finance doesn't operate in isolation. It's deeply linked to the wider economy. And post-Brexit, several indicators suggest the UK economy isn't performing as strongly as it could have compared to peer nations. Studies show that Brexit has contributed to slower productivity growth and slower trade growth with the EU in particular, compared with countries that remain in the single market. That doesn't mean the UK has no growth prospects. It means that finance is one piece of a larger picture, and Brexit's effects are broad, from borders and migration to trade and investment. This is the kind of long-term shift you don't notice day to day, but feels significant over years. So what's the real takeaway? Brexit didn't kill UK finance, but it restructured it. Jobs moved, but not en masse. Assets flowed, but London still trades big volumes. Investment slowed and regulatory complexity increased. And money flows, especially from global investors, now respond to a changed access landscape. The Brexit impact on UK finance isn't loud. It's gradual, structural, and ongoing. And that's exactly why it's hidden from most people's view. If you found this breakdown useful, hit subscribe, like this video, and let me know in the comments which financial topic you want explained next. And don't forget to share, because understanding these trends could change the way you think about money.